All right, guys, to give an update on that 2-year long Wyckoff distribution pattern we saw. All right, so we drew it basically like this. All right, somewhere along this line, we kind of followed these trends. I think we wanted a weekly. Did something like this, I believe. Essentially this, right? And you know, this sort of line comes from that rising wedge pattern we usually see when exhaustion occurs. You can actually see the, multiple indicators. You can see the exhaustion, right? If you put on a relative strength index, RSI, not stochastic, right? You can see this large bearish divergence, right, at these points. Right, upwards price action, RSI going down, classic bearish divergence, right, on the weekly too. So that's a good sign that price should go down. And this usually happens with these rising wedges, and then they collapse, right? So that's part of that line that we drew in the last video. But with Wyckoff, let's go to the monthly and see what we can do. Maybe we can alter this a little bit to fit our narrative. All right. You could look at something like this from the bodies of the candles. I don't usually use the bodies, but it doesn't matter what I do. If most traders do it and they react to it, that's all that matters. So we can still look at something like this, right? Body to body, it's kind of testing it there. Now, mind you, you're talking about a month time frame to invalidate it, so it doesn't really matter too much because, I mean, it can do a lot in that month. But the idea still stands. It could be, wow, look at that. That went up to 91, 92. Anyways, so the point that I was getting to in general is the line that I drew was invalidated because the weekly closed below it. But it was also, I think, invalidated at certain previous points down here. Like right here, I think, this area. Yeah, even before it was invalidated slightly. Point being is there are going to be times where you can't really draw the perfect line, but it stands. If it's going to last this, another, what is that, 200, let's say from tip to tip, 203 days, let's go, 203 days, May 30th, where is it? That's somewhere around there. Right, having this type of a trend line doesn't give it much time to actually go back up, or however I drew it before, right? This would give it more time to come up, but it doesn't really matter, right? The Wyckoff structure itself hasn't been broken. That trend line has been broken. Because once you create your trading ranges, it's actually a staple of the Wyckoff, like the distribution in general, and this applies to accumulation, but in reverse. When you have the up thrust, you want it to go past the 50-point line between the trading ranges, right? And what this does is, you're not going to really learn this anywhere. This comes from trading Wyckoff and looking at just hundreds and thousands of these patterns. You'll figure out if it doesn't pass that threshold, the chances of it actually being a distribution as opposed to just an upward price action with no real schematic behind it or logic. It makes it much higher that it's not a Wyckoff distribution if it doesn't pass that 50 point. That's a key point you should take with you if you're watching this video, because there's a lot of there's a lot with Wyckoff. It's just nobody tells you these little things to make you find the schematic as opposed to just a random price action, right? There's a lot of random price action that might look like a schematic, so you need more points that you can check off to find it. Like in general, when you're trying to find some structure building, you'd want to first create the trading range. That's the number one thing. Well, how do you do that? Well, you need to figure out with this case, with the distribution, the bind climax and the AR, right? You need the trading range because everything after depends on the trading range, and that's how you can gauge what will happen next at what point to a certain percentage of accuracy, right? There's always risk associated. They're never the same. If you've never read schematics before, you won't figure it out. You'll lose a lot of money because they don't look like the actual Wyckoff schematic 1 and 2. They can vary quite a bit to the point where it looks almost nothing like it if you don't know what you're looking for. And the way you read these schematics in general is you go sequentially. So you have to find the bind climax with a distribution scenario, AR, then you create your trading range. You try to do it as best as possible. It's not always perfect by any measure. I use StatCoin 1 indicator resistances, or visually I can catch it myself as well. Sometimes you can use the wicks, sometimes the bodies. There's no real rule set on that. You just find the point of most resistance. You might want to use the VPVR, the volume profiles and stuff. But once you figure out the trading range, you'll have to look at the up thrust, right? It has to leave the trading range. It's a key feature. It might bounce off the trading range a bunch of times, and unless it leaves it, it's not the up thrust. That's what makes it look different, because there could be a lot of noise here. Everything between this point, and then the next up thrust that can be actually here, it might not even pass this point. It's all noise. So when people look at the schematic, they try to compare it 1-to-1, and that's not how it's supposed to be done. So relative to this 2-year schematic, not to ramble on, I'll make some more kind of definitive videos to explain this later on. But these schematics with the 2-year long schematic, I mean, you want it to pass the 50 point. This is falling right in line. The problem is, at this point, if you've missed this kind of up thrust, then you didn't kind of use it to your advantage to short from here, right? You short around the trading range limits or long. You got to kind of wait. It doesn't mean much. So this could turn around right here. It could go down here and turn around, which is what most people are expecting. But it can also go through this and then turn around to get rid of all of this. There's a lot of liquidity here. It would not surprise me if it goes that low to go down under and then wick out everybody. And this would just be another sign of weakness, right? Which is an overall sign of weakness to the whole trend. Doesn't really mean much. It'll still go up after that, right? In fact, if it does go underneath here, nobody is going to believe that this thing is going to go all the way up. They'll have a bunch of pullbacks here, and people they will assume it won't go up, right? Every pullback, they'll assume it's going to end up going macro down structure. So anyways, I don't want to ramble on too much, but the 2-year long Wyckoff distribution itself, by no means is it invalidated. That trend line we made, which, mind you, it was just a random trend line that looked like it, had multiple touch points on a higher time frame. That one was invalidated. So this is still in play and most likely will play out because it kind of falls in line with a bunch of different, if you ever seen this, like three humps and a domed house or something like that. It's an interesting pattern. I've never seen it actually, but it falls in line with many things, especially Wyckoff. So anyways, thanks guys. Way too long. Maybe I shouldn't ramble on so much, but it is what it is.